What if I told you the rich are not chasing trends in 2026, but are quietly buying specific assets that most people are ignoring? Which I am going to reveal to you in this video. I know many people believe that working 8 hours a day and earning a high salary is the key to becoming rich. But the truth is, salaries alone rarely create real wealth. In fact, while salaries cover your bills, they often leave you exhausted, constantly thinking about your rent, school fees, and living expenses. At a certain stage, you become afraid to quit, not because you love the job, but because you don't know where the next paycheck will come from. The rich know all these things. They know that depending only on earned income keeps you stuck, and that avoiding investments out of fear can actually be the bigger risk. That's why instead of just working for money, they make their money work for them by constantly investing in assets that generate income, grow in value, and continue paying them, even during economic downturns. And in this video, we are going to look into the 5 assets the rich are using in 2026 to get even richer. The number 1 asset the rich are using to get richer in 2026 is investing in stocks. I know when most people hear the word stocks, what comes to their mind is risk, or that it is meant for the rich. But that's not true because even the rich see it differently. They see stocks as ownership. That's why when you buy a stock, you're not just buying numbers on a screen. You're buying a small piece of a real company. And as that company grows, your money grows with it. I have a detailed video explaining what a stock is and how the stock market works, so you can check that out if you want a deeper understanding. But let me show you what this looks like in real life. Now imagine you had invested in Nvidia 5 years ago when the share price was under $20. Instead of trying to trade in and out of the market, you simply held. Today, your portfolio would have grown massively. That's the power of investing in stocks. And it's not just Nvidia. Think about investors who bought stocks in many tech companies 5 years ago and simply held on. A lot of them are already planning their retirement as their portfolios have more than tripled. That's how the rich keep getting richer. In 2026, the rich are investing heavily in major tech stocks due to the AI boom, which has caused many stocks to surge. Before you know it, their investments have more than tripled. But remember this. Not all tech stocks have experienced massive growth. For example, PayPal, a popular and well-known company, has seen its stock decline significantly in recent months. That's why it's not just about investing, it's about doing proper research, understanding the company's fundamentals, analyzing its financial health, and knowing why you're investing in the first place. The rich understand this balance. They don't invest based on hype, social media excitement, or emotions. They focus on strong businesses with long-term potential, diversify their investments, and allow time and growth to work in their favor. Over time, their wealth continues to grow, not in one day and not overnight, but through consistency and patience. And when they reinvest their dividends, the power of compounding multiplies their money in the background, turning steady growth into long-term wealth. The number 2 asset the rich are using to get richer in 2026 is investing in index funds and ETFs. While individual stocks allow you to buy companies one by one, an index fund brings many companies together into one entire basket. So instead of trying to pick the next big winner, you're investing in a whole market or sector at once. This reduces risk because your money isn't depending on just one company's performance. For instance, think of an ETF as a basket of investments that contains many top companies inside it, such as Amazon, Tesla, Meta, and Nvidia. So, instead of betting on just one company to succeed, you're spreading your money across many companies. And with one ETF, you gain exposure to all of them at once. That's why many financial analysts recommend ETF investment, because they provide instant diversification, lower risk when compared to buying individual stocks, and often come with lower fees. For example, broad market ETFs like VTI give you exposure to the entire US stock market in just one investment. Another beauty of investing in ETFs is that many of them provide regular income. For instance, dividend-paying ETFs such as SCHD pay regular dividends. This means investors not only benefit from price growth, but also receive steady income along the way. In terms of returns, broad market ETFs like VOO have delivered average annual returns of 10% over the past 5 years. Sector-based ETFs like tech-focused QQQ have also witnessed massive growth, thanks to the surging investment in AI. And beyond the US markets, there are international ETFs that give investors exposure to global economies, which the rich use to grow their money. The good thing about ETFs is that they don't require any major research or overthinking because they are simple, diversified, and cost-effective. The rich don't need to constantly monitor the market or guess which stock will explode next. Instead, they invest consistently, reinvest their dividends, and allow the long-term growth of companies and economies to work in their favor. The number 3 asset the rich are using to get richer in 2026 is real estate. Real estate has always been one of the strongest wealth-building tools, not just in countries like the United States, but globally. The rich understand the power of real estate. They know that even though governments can print more money, they cannot create more land in prime locations. And that scarcity is one of the major reasons the rich invest consistently in real estate. If you are still doubting whether real estate is a good investment, think back to the 2008 financial crisis. Many people were afraid to buy properties because prices were collapsing, but that period became one of the greatest wealth-building opportunities in modern history. Investors who used the opportunity to acquire properties during the crash, when prices were heavily discounted, have seen these properties' values grow massively in the last couple of years. Some people are still living in the houses they bought during the 2008 financial crisis to date. In essence, they don't pay rent. They are their own landlord. Outside of that, real estate also acts as a hedge against inflation. For instance, when the government prints money to meet financial needs, the currency's value declines. And when that happens, physical assets such as property often appreciate in value. That's because as inflation increases, property values and rental income tend to rise as well. Now, what about interest rates? When central banks cut rates, borrowing becomes cheaper. And as borrowing costs fall, demand for property typically increases because mortgages become more affordable. That often pushes property prices higher. For example, in the United States, President Donald Trump has publicly pushed for a lower interest rate and a weaker dollar from the Federal Reserve at different times, arguing that cheaper money can boost economic growth. If the Federal Reserve yields to his demands, it could lead to more borrowing. This means people will have more money to buy properties, which will lead to more investment in real estate in 2026. The rich understand these things. That's why they are always investing in income-generating properties like rentals, commercial spaces, and land in growing areas. These assets provide steady cash flow while increasing in value over time. That's why in 2026, real estate remains one of the core assets the rich use to protect and grow their wealth. The number 4 asset the rich are using to get richer in 2026 is investing in precious metals like gold. Unlike paper money, precious metals have been used as a store of value for thousands of years. In essence, when currencies lose value due to inflation or excessive money printing, assets like gold tend to hold their purchasing power over time. That's one of the main reasons rich people keep a portion of their portfolio in metals. And gold in particular is often seen as a safe haven asset. For instance, during economic uncertainty, geopolitical tensions, market crashes, tariff wars, or rising trade conflicts, investors tend to move their money into gold to preserve wealth. For example, over the past year, a lot of investors have made more money from gold than real estate and stocks, largely because of global geopolitical tension and tariff wars. That's because when geopolitical risks increase or trade tensions escalate, markets become volatile. And when fear rises, the rich often push their capital into safe haven assets like gold. A case study is the January 2026 gold and silver rally, driven by geopolitical tensions, which saw the price of these precious metals hit a new all-time high. As we said earlier, the rich understand these patterns. They know when to invest in an asset like gold. They don't necessarily buy gold and silver expecting explosive short-term gains like stocks or cryptocurrency. They buy them for protection. That's why when uncertainty increases, the rich quietly increase their exposure to gold, not out of panic, but as a strategic move to protect and preserve their wealth. That's why in 2026, as global uncertainties continue and inflation remains a concern in many economies, precious metals remain a strategic asset the rich use to get richer. Already, major financial institution J.P. Morgan has projected that the gold price could reach $6,300 per ounce by the end of 2026, driven by strong demand from central banks and investors. The number 5 asset the rich are using to get richer in 2026 is investing in speculative assets like cryptocurrency. Although cryptocurrency is highly volatile, it has evolved far beyond its early retail-driven days. In fact, in the past few years, crypto has gone institutional, driven mainly by the approval of Bitcoin and Ethereum spot ETFs. This means that crypto has gone mainstream, with large financial institutions, hedge funds, and asset managers entering the space in a much bigger way. And the effect of this is what is seen in the market today. There is no longer anything like altcoin season because the market is no longer controlled by retailers. In essence, the market now moves not just on retail sentiment, but also on institutional flows, large block trades, and derivatives activity, which is one reason prices can swing sharply within minutes. What I mean is that crypto is no longer just about individuals buying coins on exchanges. Today, there are ETFs, futures, options, and other derivatives that allow investors to gain exposure to crypto without directly owning the underlying asset. This means you don't necessarily need to own a full Bitcoin to get involved in crypto. You can buy small fractions, invest through ETFs, or use regulated financial products that track the price. And all of these have led to one thing, which is that crypto is now more accessible and more integrated into the traditional financial system. And the rich understand these structural changes. They know crypto is a high-risk, high-reward asset, so they don't make it the foundation of their portfolio. Instead, they allocate a calculated percentage to assets like Bitcoin and Ethereum as part of a broader strategy. And they pay attention to liquidity, regulation, institutional adoption, and market cycles, not social media hype. Although cryptocurrency still remains a speculative asset in 2026, it is no longer a fringe market. It has become a financial asset class with institutional backing, sophisticated products, and global participation, and the rich position themselves accordingly, strategically, cautiously, and with proper risk management. But it's important to understand this clearly. Cryptocurrency is highly volatile. That's why the rich never go all in on crypto. They treat it as a calculated risk, not a guaranteed path to riches. Now, from the discussion so far, you can see the rich don't rely on just one asset to build wealth. In 2026, they are spreading their money across stocks, index funds and ETFs, real estate, precious metals like gold and silver, and even speculative assets like cryptocurrency. Each asset plays a different role. Some generate income, some provide growth, and others offer protection during uncertain times. Now, the key lesson is not to copy blindly, but to understand their strategy and follow it. The rich focus on diversification, patience, and long-term positioning. They protect their downside while allowing their upside to grow. Remember this: wealth is not built overnight. It's built by owning the right assets, managing risk wisely, and staying consistent, especially when markets become uncertain. Remember, this video is not financial advice. It is only for educational purposes. Investing is risky and can wipe out your portfolio if you don't know what you are doing. So always do your own research before investing. And most importantly, do not invest what you cannot afford to lose. If you found this video helpful, like, share, and subscribe. Thank you.